Okay, let's see what we have here. Continuing on with our discussion of current liabilities, let's look at question number 7. It says unearned rent revenue is, and then we have 4 choices. Okay. Choice A, it says a contra account to rent revenue. Well, rent revenue, let's talk about what a contra account is. For an item to be a contra account, it would have to appear on the same financial statement as the primary account. Rent revenue is an income statement account, okay? Unearned revenue of any type, whether it's for rent or not, is a balance sheet account. So we can eliminate choice A for that reason, okay? Choice B says a revenue account. This, again, unearned revenue is a balance sheet account. A revenue account, this is an income statement. Revenue is found on the income statement. Unearned revenue is found on the balance sheet. Therefore, choice B is wrong. Okay. Choice C, it says reported as a current liability. Okay. That is your correct answer. It is absolutely a correct answer because unearned rent must be earned within 12 months. Okay, as a rule. So our liability cannot extend past a 12-month period of time. Therefore, unearned revenue is the correct, C is the correct answer. So we want to understand what unearned revenue is. We have received cash or the promise to pay cash, but we have not yet earned the revenue. Therefore, when we have funds on hand that we have not earned, we have a liability to provide goods or services. Okay? So the key here is in this word unearned. Okay? If it's unearned, we have a liability, and in this case we have a current liability. Okay? Let's look at the next question. It says a couple of sisters operate a bed and breakfast. Doesn't matter where it's located. As customers make reservations, they are required to pay cash in advance equal to 1/2 of the rate of their stay. How do the sisters record the cash received as reservations are made? Okay. Let's see here what we have. It says, choice A, increase cash and unearned service revenue. Okay. Well, let's see here. It says they're required to pay cash, so cash should go up. So that part looks good. And it says the second part, and unearned service revenue. Well, this is a service-related business that we have here. It's a bed and breakfast. Okay. Cash has gone up, but we have not earned any of this yet because it's advance. It's an advance payment. Therefore, this second part is also true. Okay? So, A is our correct answer. But let's go ahead and keep going. B, increase cash. Okay, that's good. And service revenue. Well, not yet. We can't increase service revenue until we earn the cash, and we have not done that yet. So this part is the part that's wrong. C, decrease unearned service revenue and increase service revenue. Well, not yet. We're going to do that eventually when we earn the income, but we have not done that yet. It's still unearned because it's an advance payment. And then let's see, increase cash and sales revenue. Well, this is wrong on, this part is okay, But here we're not making a sale. This is a service business. So this part here is wrong for a couple of reasons. So again, A is our correct answer. Let's look at number 9. It says, molding company typically sells subscriptions on an annual basis and publishes 8 times a year. This is a magazine company, and they sell 60,000 subscriptions at the beginning of January for $10 each. How much unearned revenue should molding recognize as a liability? Unearned revenue is definitely a liability as of September the 30th. Okay, so the first thing we want to do is understand how much money they have received total. So to do that, we're going to take the 60,000 subscriptions and we're going to multiply it by the subscription price. And if we do that, we come up with $600,000. Okay, that's the amount that cash is going to go up. And this is taking place in the month of January. It says at the beginning of January, so we're going to assume for our purposes that they mean the very beginning of January. Plus that makes it easier. So the question wants to know how much unearned revenue should they recognize as a liability as of September 30th. Well, guess what? September 30th is the 9th month, or September is the 9th month of the year, and the 30th is the last day of September. So what we're talking about here is that 9 months of the year has passed. So 9 months over 12 equals 75%. If we were to multiply 600,000 by 75%, we would come up with $450,000. But guess what? That's not our answer. This figure here represents the amount that we've actually earned. The amount that remains unearned is the difference between these two figures. So let's go over here really quickly. $600,000 received minus $450,000 earned leaves us with $150,000 unearned revenue liability. $150,000 is our answer. All right, one more question on this particular handout. It says Sickle Stinkin' Incorporated has borrowed $50,000 by issuing a 10-year note to Great Rip-Off Bank. The note specifies that Sickle Stinkin' will make monthly payments of $500 each month. How much should the company classify as a current liability, as a long-term liability? Okay, so we have two questions here. And the first thing we need to understand is what type of a question is this? What this question is asking us to figure out, or what we're dealing with here, is a concept called current maturity of long-term debt. Okay, so the total debt is equal to $50,000 right there. That's how much they borrowed. Okay, and they did that over a 10-year period of time. So in the beginning of this note, what we need to understand is that 1 year equals a current liability, and 9 years equals a long-term non-current liability. Okay, now all we really have to do here is simply take $50,000 and divide by 10, the term of the note. And if we do that, we come up with $5,000. This $5,000 answers the first part of the question. $5,000 is a current liability. Liability. Okay. Well, if we were to take $50,000 and subtract the $5,000 current liability, we would come up with $45,000, and that is our long-term liability. Okay? Now they have tried to confuse you, or maybe I tried to confuse you, by putting in the monthly payment here of $500 each. And if we look at that, we look at $500 times 12, we're going to come up with $6,000 paid per year. Okay? We don't really need that information. Okay? Conceptually, we might say, well, what this tells us is that $5,000 goes to principal and $1,000 goes to interest. Okay? But we don't really have to know that to answer this question. So these are our two answers.